first. Okay, there we go. Drink a little water. About to get going here. Brother Hilario, how you doing today? I see you joined us. He probably got his mic muted.
Doing very well. Thank you for the
Good,
invitation.
good. Yes, sir. Yes, sir. I'm glad you can join us. So I reached out to you, but I know you busy. You busy man. Well, you really busy man right there.
I had two other obligations, but I said, you know what, I can kind of push those on the backside, and I'm gonna go
Yes,
ahead
sir.
and take
Yes, sir.
this meeting.
Yeah. So yeah, because I wanted to get your email because with this, I sent some of the material that we're going to be going over, and I wanted you to get a little precursor of what it was about. So this is pretty informal, what we do here, and the object is to get you to understand a little bit about what subject to is, what you can utilize it for, what it's not, and how it can help you in the future. So this is a Q&A session here. That's what this really is. This is how we started. And the future classes, we're going to start dealing with marketing, and we're going to start dealing with the contracts, the agreements. I teach you how to put the properties in a trust for privacy as well. Because as I tell everyone, and everyone knows, if you deal with real estate and you potentially can be a target for not just a legitimate lawsuit, but for any frivolous lawsuits. People know that you got property they can fall or feign falling, and even if they're wrong, and even if they're right, anybody can sue. And even if you are successful in countersuing, it's going to cost you some money. So to avoid you being a target, we teach you to put your property in a trust for anonymity and privacy. So that's another benefit of learning this class through how I teach it, subject to. So not only you're going to learn how to get the properties and hold them correctly, you're going to learn how to put them in the trust, and then you're going to learn how to flip them or dispose them. Okay. One of the I would say misnotions, if that's what you want to call it, about subject to, it's real estate investing. That's what it really is. It is real estate investing in its pure form. A lot of people mostly are familiar with what we call wholesaling or flipping. And wholesaling is real estate investing, quote unquote. That's what they say. I tend to disagree, but it could be a form of that. But the reason why I have some disagreement, and not wholly disagreement, because it is a part of real estate transaction, is that when you wholesale, you typically are going to get a contract signed or an agreement with a homeowner or a seller of a property. And once you have that contract, you have what they call equitable interest, all right, which allows you to take that document, that contract, and sell it to an end buyer. And that end buyer and the seller is going to come together and they're going to consummate the deal. That's wholesaling. You be a middleman. So wholesaling, you really don't acquire the property at all. You make some money. You make some money by getting a property at below retail value and then selling it to the end buyer at close to retail value. You make money in the middle. But in my humble opinion, that's not real estate investing, because you're not acquiring real estate. You're wholesaling, and that's what it is. You're a middleman. Nothing wrong with that, because with subject to, you can wholesale too. Okay. However, with subject to, when you wholesale, you own the properties. Okay. These properties are yours. You have the deed to them, and you can do whatever you want. You don't need a license. You don't need to be a realtor to do subject to, and you don't need to be a licensed realtor. The reason why is because the reason why realtors have to be licensed in almost every state is because they either representing a seller or they're representing a buyer who owns the property. The realtor doesn't own the property. They're in a fiduciary responsibility position where they're representing sellers and buyers, and they don't own the property. They just make a commission. To do that, you need to have a license. With subject to private real estate investing, the reason why you don't need a license is because you are going to own the property. Just like when you sell. So when you want to sell your own house that you bought, you got a mortgage for, you're living in a couple of years, and you want to sell it, you don't need to go to the board of realtors to ask for a license to go ahead and sell your property at all. Okay, because you're the deed owner, you're on title at the county recorder's office. So the same thing with subject to. When you get these properties, you're going to have title and deed on record at the county recorder's office. And of course, you have options of to how to place that title publicly. I advocate, and other people who do this advocate that you put it in a trust. You have a trustee do it, but you can do whatever you want. You can put your own name on it if you like. Bottom line is you're the older owner, you're the controller, and you can sell these properties without license. Don't let anyone tell you that you need to be licensed to do private real estate investing. No, you do not, particularly when you own the properties. All right. So, any questions before we get into our subject matter?
Not yet.
All right, good deal. So, what I'm going to do is I'm going to share this screen. And bear with me, I'm more proficient in the topic than in this technical sharing here. Just give me a minute. I'm going to open up my screen.
Question.
Yes, sir.
Although you get the title and deed in your name, you still have a lien on it from the bank like the original owner did, right?
Absolutely. Absolutely. And we're going to discuss that. Very, very good question. That's a very important question. And for some people, that is a negative, but actually it is a positive. And we're going to go through the positive. So I'm sharing the screen here. All right. And, oh, no, this is not the one I want to share. Excuse me, not yet. Bear with me. But that's a very good question, Hilario. Excellent one. If I can find. Show all windows. Here we go. All right. So here we go. Here's the strategy of subject to. And we're definitely going to cover your comment that you made, Hilario. And anybody who has any questions, don't feel that you're being disrespectful to interrupt me, because I tend to just ramble and keep reading and talking. Ask me a question at any particular time. This is a good Q&A session, and that's what it's for, okay? So this is the strategy of subject to, okay? Now, this is a strategy that you can take to the bank. You and I live in the real world, not ivory towers that info commercial gurus speak of, because I'm not a real estate info guru. I'm one of the brothers or the people who deal with subject to and teach that actually practice this. I've been doing this for 20 years. I first started doing it in 2001, and I've done it on and off. Every time we have the so-called real estate crashes that come in, I get in for those 3, 4, 5 years, and I get the real estate, I flip it, I make some money. So the third wave is about to come. And I'm telling people, get ready for this now. Don't wait to the last minute. All right. So I'm one of those, again, that practice it, know how to do it, and I teach it, and I help you get into this. And trust me, when you get into this, you're going to realize this is probably the best real estate tool, one of the best real estate tools that you can put on the belt. So anyway, in the real world, nobody has an unlimited amount of cash and credit, right? I didn't when I didn't start, when I started out. And quite frankly, it wouldn't have mattered if I had $50 million in the bank, a sky-high credit rating. The fact is, it doesn't make sense to use your own personal resources to invest in real estate, since there's a definitely better way. And you can. Most people get a loan, all right, or several loans. And remember, there's a cap onto the amount of loans and money that you can borrow from the bank if you want to get multiple properties. The beauty about subject to is that you can have unlimited properties. Let me tell you, I think it was 2014 or 15. I had 26 properties. Didn't have no loans on them at all. No outstanding loans that I had in my name, but each property came with an existing loan and a mortgage. All right. Didn't have to put my credit on the line. I didn't have to have a credit score. I didn't have to do any kind of qualifications. All I did was make a private transaction between myself and the seller. And the seller obviously has to be motivated. Okay, so when you do these subject to transactions, you're going to have to deal with or look for motivated sellers, because not everyone is going to do this. They're not going to just give you the keys and walk away. They need to have a reason. And there are going to be people who have this reason when we get to the real estate debacle that's about to happen. Okay. So I and others like me figured out a great strategy that doesn't require any of my cash or credit, yet it still makes serious, consistent cash flow. Here's how it works. The system is fundamentally simple. All I do is find houses that I can buy without using my own cash or credit. And we're going to talk more about that later, even though I did touch on it. And I simultaneously find a buyer who wants to buy the property from me. I buy from one, sell to other, and I keep the difference. All right. Now that happens over a period. because we talked a little bit about wholesaling, and wholesaling, you're going to get a contract, you're going to find a buyer, and usually within a short period of time, you're going to make that money and flip that property, even though you don't own it. With subject to, since you own the property, what's going to happen is after you get the property from the homeowner or the seller and they turn it over to you, you're going to take that property. And one of the end games that you can do is what we prefer. It's called rent to own or lease with option to buy. Not renters, okay? We don't put renters in the property. We put people who want to rent to own or lease with option to buy. The reason why, you can rent a property, okay? You can rent a property today, rent out a property, and of course, you're probably going to get a month's rent, and you're probably going to get a month's security deposit, and maybe a little bit more, maybe if law allows. However, if something happens, that renter does not have any skin in the game, number one. So if they default, of course, all you got is that security deposit to rely on, if you can do that by law. In most cases, you cannot, only under certain circumstances. Number two, very important reason is that when you establish yourself in a standard landlord-tenant relationship, if the AC breaks down or if there's a bust in one of the pipes in the wintertime or something happens to the property, I or you as the landlord have to come out of my pocket or your pocket, and you have to make those repairs, okay? You have to do that because the tenant does not own the property, nor does the tenant have an obligation to fix it, because the tenant is not intending on purchasing any property. He's only leasing it for a particular period of time, and that's it. You own the property. However, when we teach subject to, we teach you to take these properties and you put the properties on the market in a rent to own status or lease with option to buy. Because what happens is that you make money three different ways. When you first get the property and you market it, you're going to market it to a tenant buyer who has to give you what we call an option payment. Okay, an option payment is similar to a down payment. We don't call it a down payment, of course, because we can't, because we're not mortgage brokers and we're not licensed, remember, but we're homeowners who own the property. So it's an option payment. So you're going to put your tenant in a contract, your tenant buyer in a contract where they have an option to purchase the property. And to exercise that option and to start it, they have to give you an option payment. And let me tell you, the option payment can be thousands of dollars. It's almost the same thing as a down payment when someone puts a mortgage down. It can be 20%, 5%, 15%. The average option payment that I usually collect is anywhere between $5,000 and $10,000 upfront. And that's what the tenant buyer is going to give me because they intend to purchase this property at the end. So they're going to give me an option payment. So I'm not just collecting a month's rent and month's security. I'm collecting a maximum option payment. Okay, like I said, it could be anywhere between $5,000 to $10,000 or $3,000, whatever you want it to be. And then remember, you have a mortgage that you're going to pay because you took over the existing mortgage from the former homeowner. Let's say that mortgage is about $1,400 a month for a 3-bedroom, 2-bath, right? So what you typically are going to do, you're on the top of that $1,400 a month that you're obligated and morally and legally say that you're going to pay the mortgage company after you take it over from the homeowner, is that you're going to add something on top of there to your tenant buyer, which is going to be about $200. So let's say you have a contract for 1 year or maybe 2 years for that lease option agreement. So for the next 24 or 12 months, whatever it may be, you're going to collect an extra $200 on top of the mortgage. So you already made money in the beginning, right? That upfront option payment. And now during the term of this lease option, you're going to make $200 a month or $300 or whatever the market can bear. And right now, rentals are really high. You can make $300, $400, $500 on top of that if the market can bear it. So bottom line, you're going to make money on the front, you're going to make money on the middle. And then when your tenant buyer, the reason why they got into a lease option agreement is that they are going to exercise the option to get financing to pay off the existing loan that you took over. So you're going to make money on the front, you're going to make money on the middle, and you're going to make money on the back end, right? So I was just giving you a basic premise, and that's what we're going to get into right now. Okay, so here's how it works. So again, buy from one, sell to the other. Sometimes we'll find that the buyer that we advertise for that does the lease option can get a loan right away. So sometimes I check to see if they have good credit and maybe they can get a loan right away. And boom, guess what? You sell the whole entire property right there on the spot or within 30 days, and you get that happen. So when that happens, you get to put all the cash in your pocket right away, get a nice fat cash profit immediately. You pay off the former owner's existing loan, and you pocket the proceeds. And you can do that, all right? Not because you're on the loan or the mortgage. You can do that because you're on the deed. Whoever is on the deed is the one who gets the proceeds from the sale of the house. That's always the way it has been in real estate. That's why when you purchase a property in traditional ways, it's always signing the deed over to you. And whoever's signing that deed over to you is the one that's going to get the profits of selling the house. The same thing that you're going to do. Any questions? Okay, good. So if the buyer can't get a loan immediately, but we'll be able to do so sometime soon, okay, we're going to sell the house to the buyer using a lease option. Okay, we're going to talk about that more later, which is actually a very good thing for 3 reasons. When selling on a lease option, you make money fast because you're going to get that big down payment. We talked about that option. Okay. And lease options allow you to make money each and every month. We talked about that money you're going to make in the middle without any real effort from you. And then a few months down the road, 24, about 12 months or 36 months, whatever your lease option term is, you probably get to pay off that mortgage, and then you get paid again. That's what happens. Now, the benefit to this over rentals versus rent to own is you do not fix toilets or do other property maintenance, especially when you sell this property through a lease option. Okay, it's simple, and doing property repairs is not part of the equation. This is to keep money in your pocket. People are going into these lease option agreements with the intention to purchase. So just like when you get a mortgage from Chase or you get a mortgage from Wells Fargo, whoever your mortgage lender is, if your AC goes out, are you going to call your mortgage lender and say, hey, my AC went out? They're going to say, well, sorry to hear that. Hope everything works out. Do you have somebody to repair for you? Thank you very much. By the way, our payment is due on the 1st. So they have no obligation to fix your repair or fix your AC or whatever the case may be. So you place yourself in the same position with your tenant buyers because they are buying. And remember, when you get a mortgage, traditionally you're buying. You own the house in a certain regard, but until it's fully paid off, right? That lender still has a tie to the property where he can take it back if you default. And the same thing happens when you do a lease with option to buy. All right. Any questions? All right. So here's how a typical deal might work. Okay. A motivated seller, and this is getting the properties. So a motivated seller will respond to the marketing. There's different ways you can market, and we'll get into marketing a little bit after this. So you discover that a seller has a home worth, let's say, $130,000. Of course, these figures no way reflect today's figures because things have totally changed in real estate. All right, but this is just for example. So, for example, a seller has a home worth $130,000, and trust me, back in the day when I started, those were the prices. $130,000 for a nice 2-bedroom, 3-bedroom home with a remaining mortgage balance of $105 and a monthly payment of $825. Okay. So we buy the property by just taking over the monthly payments. That's the agreement that we're making. Okay. And we'll get into why you can do that and why a seller would do this in just a little bit, but we're going to get to this part first. So we immediately, once we get the property, we attempt to resell the property using a lease option, just like I told you. You set the sales price at $135. Okay. And a monthly rental rate of $1,100. Remember, the homeowner's mortgage is $825. Here you're doing it at $1,100. This is just an example. And then you require that down payment and option payment from your buyer, 3 to 5% of the price. Boom. So upfront, you're going to make $5,400 in this example. Your monthly cash flow is $275. And then when you sell the house, boom, you're going to make the difference between what's owed on the mortgage, $105, and what you sold it for. Voila. So you make a total, in this case, $33,000, after 12 months of cash flow. That's not a bad deal. That's typically how this works, okay? So you're probably wondering, how is it that you buy a property without cash or credit? Yada, 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 boom. So we're gonna go into the next phase of this. Is there any questions on anything we covered? I mean, this is pretty explanatory, right, on what I just covered. So I'm sure you guys don't have any questions. All right, so let's go into actually a little bit more about subject to. What's a subject to deal? Okay. So the homeowner gives you a property. Unlike a traditional scenario, this property, as Hilaria, as you correctly stated, is not free of a lien. The property comes with the existing mortgage. In a typical transaction with real estate, when you buy a piece of property, whether it's land or a house from someone, you have to get a mortgage loan or you have to have cash, and you have to pay off the current owner's mortgage before he signs that property and that deed over to you. Okay. However, this is called subject to because you are acquiring the property subject to the existing mortgage. All right, we got somebody that just popped in here. Let me okay.
It's me. I'm switching to my laptop.
Oh, that's okay. So again, you're acquiring the property subject to the existing mortgage. That's why it's called subject to, because the whole transaction is still subject to the existing lien that is still on the property. Now, some say that that's not, well, I got a property with a mortgage on it. That's not, I don't want. No, you do. Let me tell you, because you didn't sign that mortgage agreement legally. And according to the bank and according to the law, whoever signs that mortgage agreement, they're typically responsible for the mortgage. Now, remember, I'll tell you, you're dealing with motivated sellers. Motivated sellers. What would make a person motivated? That they would just turn their property over to you and give you the keys, sign the deed over to you, and walk away. Anybody have any reasons why somebody might do that? You want to share that? Or give an example of what you think? If you were going to give a property to someone and give them the keys, why would you do that? What situation could come about? Well, let's talk about it. Foreclosure. Number one. That's the number one reason. A lot of people.
Family member.
Yeah, go ahead. What'd you say, Debbie?
I was going to say foreclosure. I was trying to hit the thing.
Oh, yes, ma'am.
Credit and loss of family member, low in your income change.
Absolutely. A number of reasons, right? So what happens is that in a pre-foreclosure situation, in most cases, these people have lost their income. They've lost their job. And since they have a mortgage debt on the books, if they foreclose, it's going to affect their credit drastically. It's going to affect their credit drastically. And they may not be able to sell. All right. They may not have equity. Okay. They may not even have time. So a number of situations make these people motivated. And let me tell you, when this real estate debacle comes to a head, which could happen at any time, could be this year, next year, whenever it is, you're going to have motivated sellers who will absolutely give you the keys to their property and sign the deed and walk away because they have no choice. The only choice they have is to actually walk away and foreclose. I can't tell you how many people, after they found out what I do and other real estate investors who do subject to, when they find out that they could have turned the property over to someone instead of voluntarily walking away, they were just flabbergasted because that's what they would have done. They would have said, well, let me take a chance with you, 50-50. You might be able to keep the property in good shape and you might be able to get the mortgage paid until you can satisfy the existing lien. And they couldn't do it. So that's the number one reason, is that they don't want to foreclose and have that and nowadays you're talking about a $300,000 mortgage, $400,000 mortgage, on their credit, okay, on their head. They don't want that. And you could say, well, why don't they just sell the property? Well, the thing is, most times they can't sell the property. A lot of times the property value is right there in what they owe. And even if they have a little bit of equity, with a property, especially nowadays, a property that's $400,000, $500,000. I mean, it's crazy what the value of these properties are. You're going to have to pay realtors commissions, and there's usually two realtors, one on both sides, 3% for the selling realtor, which may represent you, 3% for the buyer's realtor. That's 6% of the total price of your property that you're going to have to pay, and then closing costs. Okay, so that might eat up all your equity, or if you have just a certain amount of equity, you still might have to come to the table with thousands of dollars to close. And most of these people, if you've lost your job, all right, you don't have money to come to the table. Okay, you don't have no money, or you may have money, you may have a savings that you've been saving on so you can actually move, and get yourself in a more comfortable place and downgrade, but you don't want to put it on this mortgage and walk away and then you're done. So that's an example of why someone would do that. And more often than not, this happens a lot. So that's exactly how this works. Okay. So a subject to deal is basically the same thing as an old assumable loan. Okay. Now there were loans that were assumable back in the day, which means that a property owner could personally make a transaction with someone and have them assume their loans. Those were typically loans before 1982. A lot of FHA loans, a lot of veteran loans and whatnot. A person could just simply sign the deed over to you and you just simply take over the existing mortgage. Banks did not like that. The number one reason why banks didn't like it, okay, is because first of all, they couldn't run a credit check on the new person. Second of all, they couldn't charge a down payment. Third of all, they couldn't raise the interest rates because remember, you're taking over the loan with the same interest rate and the same obligations and the same terms that the former owner had, and that's what you got. So they were out of the game, all right? They'd find out later that someone was making the payments and they couldn't do anything about it. That's the number one real reason why they stopped and put a clause called the due on sale clause in every mortgage after that time, because now when you do that, banks are going to want to know who the person is making their mortgage payments. Let's run their credit. Let's see if we can get a down payment. Let's see what their credit score is, you know, and so forth and so forth. And they're going to make money off of the transaction. Now, there's ways to go around that, and we're going to discuss that too. Okay, so there's ways to make the new loans after 1982 that are non-assumable, quote unquote assumable. And that's how you get these properties subject to. So this is part of the education that I'm going to give you and how you do that legally with no problem. It's not going to be illegal. Subject to is not illegal. Once we go to the rest of this course and the beginnings, you're going to see, I'm going to pull out quotes from real estate manuals that are taught throughout the country. They talk about subject to. They tell realtors, see, if you ask a realtor, most realtors don't know how to do or practice subject to. They don't. However, they're taught that subject to exists. Okay, I have a daughter who's a realtor. I have a son who's a realtor. They told me, they show me their real estate books. They have a page on it, sometimes half a page, it's not much, talking about what a subject to deal is, what we just talked about, but they don't teach them how to do it. Okay, it's not a practicable thing that they do because that's not what they want people to do. All right, so it's legal to do. And if you look on every closing document, when you close, there's a line on it. Okay, I think it's line 503 that talks about taking loans assumable. So let's look at that real quick. We're going to share the screen. And let me pull that up for thou, so thou can see it. And here we go. This is the HUD-1. This is a document when you close and you close on a property traditionally, all right? This is the settlement statement. So when you're buying from a buyer and you're this, you're buying from a seller and you're the buyer, it's going to show, the amount due from the borrower, the amount that's going to be the seller's going to get this, that, and the other, yada, yada, yada. This is on every single settlement statement in the country for every transaction in real estate when you buy and sell. Now, you can pull up one. If you have a property already, pull up yours. On your settlement statement, you'll see that, but you didn't notice it because they don't point it out to you. It's line 203 and line 503. It says existing loans taken subject to. Every realtor knows about it, but they're not taught how to do it, so they don't practice it. This is typically relegated to realtors who get into the real practice of real estate, and they're in there for maybe 15, 20 years. They know how to do this, or private real estate investors like us. So this is proof that it is legal. Existing loans taken subject to, it's here. But if you look on a typical settlement statement that you have, maybe you purchased a house, or you have a family and purchased a house, look at their settlement statement. You're going to see all this fill out, most of the lines with the exception of some, but you're not going to see line 203 and 503 fill out because the property is not taken subject to. If the property is taken subject to, that's when you're going to see that fill out. And the reason why it's still there on every settlement statement is because, my friends, it can be done. Got it? All right. I just wanted to share that with you. Any questions? So
Nope.
What I'm going to teach you is how to do it. That's what we're going to do. We're going to teach you how to do subject to. All right. So I was basically going through the premise, and what this subject to these things I put together here is basically what we talked about. Okay. All right. The person deeds the property over to you. So you're going to be the new owner. So you go and buy a property. Right. And you didn't have the money to pay cash for the property. Right. This is a typical way you do it. All right. You don't have money. Now, we're not talking about subject to. You borrow from ABC lending company. ABC wants collateral. They give you a mortgage. They put a mortgage on the property to secure the debt, deed, that, and the other. Okay, deal is complete. Owner of the property, yada, yada, yada. Okay, so a person that owns the property, something can happen in their life. Maybe a job transfer. We talked about foreclosure, losing their jobs, whatever. Okay, so most people got to react very quickly. Maybe they can't sell, just like we talked about. They may not have the equity, or they may not have time. Okay, or they may not want to. Some people have given me properties with equity in it because of some emotional attachment that they don't want to deal with. Could be death in the family, could be divorce, right? Any questions? Did I hear someone that had a question here? Okay, good. So my approach, and us who approach these homeowners, is we approach it a different way. Okay, we explain to them that we have the ability to have them just deed the house to me, and that will take over the mortgage payments. Very simple. Now, it's a little bit more detailed than that, but that's it. So let's say you're the homeowner. So I explained to you that it's a lot like a lease because I'll be paying a mortgage that's in your name, but it's different because I'll be the owner of the property. Because I tell people, obviously, I'm not going to want to pay a mortgage and not going to have some, confidence that I own this property. If I'm going to put some money toward that mortgage payment, I want to make sure that I have the ability to sell this property. I don't want to just make a mortgage payment and then you change your mind and I don't have the deed. So in exchange for me making the mortgage payments, Mr. Homeowner, and getting you out of foreclosure and maybe making up your back payments, if that's what it entails, okay? You give me the deed to the property and you move on. I take over and you move on, okay? So that's pretty much what we're going to tell them. So when you complete this type of transaction, you're going to actually hold the deed to the property, which means you're going to be the de facto owner at the county recorder's office. When you're the owner, you can lease, you can rent, you can sell, you can do anything you want. You can move into it. I've taught this course to a number of people who told me, I want to be a real estate investor, and they took the course, this, that, and the other. And you know what they did? They found a property, 3-bedroom, 2-bath, pool, everything, moved their family, and that was the only property they ever got. Nothing wrong with that. But they were allowed and finally realized that they can do this without putting their credit on the line, without coming up with a huge down payment, without having to worry about a FICO score, all right, and finding the property that they like. And they made the private transaction, because that's what it is, between you and the homeowner, but you publicly record it as the legal owner, all right? And that's exactly what happened. So again, subject to deals are an incredible way to buy property. And these types of transactions truly, absolutely never, ever, ever, ever require any of your credit. All right. Any questions at this particular interval of dispensation? Anybody? Or I must be explaining it really good, huh? Okay, well, that's good. So we'll move on to the next section here, part 2. Okay, so let's face it, buying a house subject to the existing mortgage is an awesome way to buy property. No credit required. It's a beautiful thing. Okay, now, of course, there's some less than perfect features of subject to transactions. Okay, the concept can be difficult to sell to anyone but the most motivated of sellers. Of course, remember I told you, an average typical seller or homeowner is not going to do subject to. You know why? They don't need to. They've got equity. They can sell it. They can wait. They got time. Let's see, rise the price, especially with market values. No problem. They can get their money and move on. These are for motivated sellers in particular situations. And as time goes on and this credit crunch and this housing debacle comes to a head, you're going to see a lot of motivated sellers. Ask me how. This same scenario prior to the last crash was just like it was before. Property values went up for a different reason. A lot of people were getting properties, this, that, and the other. Most people couldn't afford them. Most people had these, what we call liar loans. They weren't supposed to have these properties. They got them, took the equity out, walked away. But it's similar to what's about to happen today. It's the calm before the storm. And then the one before that I was involved in. All right, the scenario was the same. Realtors and everybody talking about, it's never going to crash. It's going to maintain this. But no, it's going to happen. And when it happens, if you prepare yourself now ahead of time before the deluge, you're going to be prepared when everyone else is going to scramble to learn how to do this. Because I'm telling you, most people do. Now, when I'm going to tell you something, I charge $8.99 for the course. That's $900. All right. It's a lot of money to some people it's not. When I was doing it prior to the crash, the last two, I was selling it easy for $2,500, $3,000, and people paid it. People used to meet me at Starbucks. They used to meet me at Denny's, and they'd listen to my and take out their checkbook and write it, give me the three easy because they knew what time it was. The closer it get, and they were at the cusp of the real estate debacle. It was crashing then. When it's crashing then, people are going to be very motivated to give these properties away and motivated to learn. So right now, the price I'm charging, and I'm not talking about money right now, but I'm just saying for the price that you're getting it for is a deal. Trust me, because when the real estate debacle happens, I can easily sell this knowledge, wisdom, skill, and the documents and show you how to do it for $2,500 easy. Easy. So those of you who come in right now, you got a good deal or whatever the case may be, but you're not obligated. This is just a Q&A. I just want to see, and you want to see if this is for you. All right. So again, the concept can be difficult to sell to anyone but the most motivated of sellers because that's the seller's name stays on the mortgage and therefore their credit is at risk. Okay. So there's no easy way to get out of a subject to deal other than not making the payments, but that's totally unethical because when you sign these contracts that I gave you, you have a moral and ethical obligation and legal obligation to make the payments because after, yeah, actually, you know, the reason why the person signed the deed over because you said you would stop the foreclosure and make the mortgage payments. You got to keep up to that. Ask me how I know. Now I'm going to tell you, I've made mistakes in this business. I've been doing it for 20 years. I made mistakes. Yeah. So I think it's good that you can learn from someone who say, well, you know, I never made mistakes, 100% successful, and that's all good. But you have a benefit from learning from someone who made mistakes and knows not only what to do, but guess what not to do. So I can give you that part where you may not get from someone who's 100% successful. They can only theorize and give you a theory about, oh, don't do that because that might happen. I can tell you when you do that, that's going to happen. And what you can do to stop that from happening and how you can see yourself going down that road and change because I've had it happen to me. Okay. And I don't think that they were, I think they were lessons. That's how I look at it. I don't really look at it as mistakes, lessons, you know? So I'm here to teach you lessons and get you to the point, and I will get you to that point if you take the Subject to course, where not only you're going to learn what to do, but I will be able to teach you what not to do so you can avoid making some of the mistakes that I and other people have made in the past. All right. So homeowners insurance, that can be tricky to handle. So I can teach you how to do that. Okay. In some cases, you might need to keep the old insurance policy in place and add a new one. However, there's caveats to that. I'll teach you how to do that exactly right. Because since you're going to own the property, should a fire happen or a tree fall into the property or burn up or whatever, you're going to want to have insurance and you want to be covered. And guess what? Even though the property mortgage is in the former owner's name, who's on the deed on that insurance policy is going to get paid. And that's going to be you. And I teach you how to do that too, how to handle the insurance. Okay. Now, subject to closings can be somewhat complicated because it's necessary in the way we teach it to create a land trust, appoint a trustee, assignment beneficial interest. So one of the beauties about learning subject to the way I and certain practitioners teach this is that we're not just going to teach you how to talk to a homeowner and get the property, do a contract, and make some money off of it. We're going to teach you how to keep your property private from the public to avoid litigation, to avoid being sued, avoid someone trying to just get your properties because they found out, oh, this person, Hilaria or Eric or John, they got a bunch of properties. Yeah, let me sue them. Let me fall under this, that, and you're a target. Okay, so I teach you also how to do trust. And let me tell you, look up the word trust. Look up living trust, look up land trust, look up living trust in Google. Call an attorney and ask them, say, you know, I got a property, I want to put it in a trust. You know what they're going to charge you? They're going to charge you a lot of money. I won't even name what they're going to charge you. So I'm going to teach you the basics about how doing a trust for yourself. Okay, now you're not going to be falling under no gray areas where you say, well, if I do a trust, this, that, and the other, I'm not a lawyer. No, you can do a trust for yourself. Homeowners do their own trust if they know how to do it, but most people don't, so they have to hire an attorney to do it. But you're going to learn how to do these properties and put them in a trust to protect your transactions and to be private. So no one knows you own these properties. You can sue and take your stuff, your hard-earned money. All right. So there's a lot of benefits to learning it this way and from me. Okay. Again, it's an awesome way to buy property because it gives you the ability to leverage your property in an incredible way. Let me tell you this. Let's say you get 5 properties subject to the mortgage. You got property A on this street, property this on this street, this street. You got this property here. You got 5 properties, right? They got someone else's name on the mortgage, but you got the deed, right? Did you know that you can take those properties with the deed and go to any bank and say, you know what, here you go. I've got this collateral here because it's in your name. I want to get a loan. Skin in the game. You don't think you're going to be able to get a loan? See, before, most of us, we can't get a loan. But here you are getting property subject to the mortgage with no credit, no money down, and yet you have these properties that you own in your name, and now you can use this collateral to do whatever you want. Get a real loan if you want to do that, which I avoid, I'm against. But if you want to do that, if you need to do it, you want to finance something, you have skin in the game to do that. That's right. That's how that works. So there's definitely benefits. And it's an absolute undeniable way of owning property subject to. So it's a great way in creative real estate to start. Any questions at this particular interval of dispensation? I know I ramble on a little bit. Remember, if I ramble on, I tell you, don't feel bad at stopping me and asking any questions because, I tend to get carried away because I'm very animate about this subject. I know it very, very well. 20 years of experience. Okay. If I had real estate, look, I had an attorney close the door one day in private and tell the secretary, can you leave the room for a second? And he was a real estate attorney here in Arizona, a very famous real estate attorney, one of the best because I hired him for something I was doing way back in the day. And he closed the door and he said, I don't want you to think I'm being racist or anything. He said, but I don't know a black guy like you who knows this like this. He said, you know how to do trusts? He said, I'm looking at your trust agreement and I'm looking at this. He said, my God. He said, we charge to do a trust for a person. He said, you actually know how to do this? I said, yeah. And I teach how to do it. See, I know this subject. Okay. Now I'm not trying to blow myself up, but I'm letting you know you're learning from someone who actually has a little bit of skill and experience in this. And I'm going to show you how I do it. Now remember, I'm not an attorney. I'm not a lawyer. I'm not practicing law. What I'm doing is I'm going to explain to you and show you how I do it. You can take it or leave it alone. You can still go to an attorney and have them teach you how to do trust, this, that, and the other. But, as a person to person, I can share this with you. And that's exactly what I'm doing. Okay. All right. So let's move on to here we go. This is what we're going to talk about. Any questions at this particular interval of dispensation? All right, we got 8 minutes. So 8 minutes, we're going to go through this. As I promised, I told you this is not illegal to do. All right, it's in the real estate world. They just do not talk about it. Okay, so this is an example and more proof of skeptics because you have a lot of skeptics out there. You have people who don't practice real estate will tell you, nah. You have people who practice. I have real estate agents who tell me, oh, blah, 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 blah. But then I had no real estate and tell me, oh, hell yeah, because they know. They do some more research. They're beyond getting a commission and representing a buyer and a seller. There's a lot now of real estate agents who are learning subject to, in addition to what they've learned and having a state license to do real estate, because you can do that. Okay, you can be a real estate agent and you can be a private real estate practitioner, but you have to let people know and disclose that you are an agent. That's the law. So a lot of real estate agents are now learning the art of subject to, and it makes sense that they do that. Okay, so this is an excerpt, from Modern Real Estate Practice. That's what it's called. One of the many real estate training manuals that is used throughout the US and is used virtually by all states as a guideline for real estate training manuals, specific for their state. So each state still has specific guidelines, but they all talk about subject to. So this one is called Modern Real Estate Practice. Look it up. It's in there by Dearborn Press. Okay, so it goes on to say when a person purchases real estate that has an outstanding mortgage or deed of trust, the buyer, which is you, may take the property in one of 2 ways. The property may be purchased subject to the mortgage or the trust. The buyers may assume the mortgage or deed and pay the debt. Okay, the technical distinction becomes important, and we're talking about assumptions back in the day. All right, so when a property is sold subject to the mortgage, The buyer is not personally obligated to pay the debt in full. The buyer takes title to the real estate, knowing that he or she must make payments on the existing loan. In the event of default, the lender can still foreclose and the property is sold by court order to pay the debt. If the sale does not pay off the entire debt, the purchaser, which is you, the buyer, the investor, is not liable for the difference legally. You're not. Should you make a mistake, and which I have, I've had probably, oh God, maybe 150 properties over the 20 years, and I have foreclosed on probably about 15 of them. Okay, some by my own error and some by not. When they have foreclosed, even though I had title and deed to the property, none of that foreclosure ever went against my credit. My name was never even mentioned at all because it's always on the person who signed the mortgage. Now, that's a pro and con, okay? The pro is it's not going to affect you legally and it's not going to affect you financially. However, you did a moral, legal, and ethical obligation that you signed with the former homeowner that you would pay this mortgage. That's the thing you want to do, because when you don't do that and pay the mortgage after you get the deed, then of course they're on the hook and their credit will suffer. Now, let me tell you, they have people called strategic defaulters. Strategic defaulters are people who get properties for the purpose of not just living in it, but they use it so they can use it as an ATM. So nowadays, a lot of people buy properties, the value goes up. Oh, good. There's $200,000, $300,000 of equity, boom. And they go ahead and cash out that equity, get a home equity line of credit or a second mortgage, cash it out, boom, boom, this, that, and the other, finance their vacation, buy another home, buy jewelry, furniture, do what they want to do, already have a second home, all right? Maybe rent it out. And then when property values goes down, see, they intend to foreclose. They're strategically defaulting. They know they're using this to get money and take the hit on their credit, knowing they already got another property to move in, everything is good. They downgraded, got their money out of it. So strategic defaulters, I come across them all the time in the real estate debacles, the crashes that come, okay? And they'll be more than happy to turn the property over to you. Why? Because they were already intending to default and they set up steps and stages. So when I default, this is what's gonna happen. I got my house, I got everything rent, got my money, boom, let it go. I'll take the hit for 7 years, I'm good, okay? However, you can come into those strategic defaulters. They'd be more than happy to give the property to you. You can remember, they were going to walk away intentionally anyway. So you definitely want that kind of motivated seller. Okay. And you're going to be able to find them. They're going to be out there looking for you. All right. I've met plenty of them say, oh my God, I walked away and let the property. I didn't know. I would give it to you and give it a shot. Okay. Now you may have to pay them a little money for it or maybe not. And let me tell you, in most cases, I'm going to tell you, when it comes to motivated sellers, in 60 to 75% of the transactions, you will not have to give the seller any money. Because the deal is, I'm going to stop your foreclosure, okay? I'm going to make your mortgage payments and possibly make up the back payments. And you're going to sign the deed and you're going to walk away and you're going to have that headache gone. No cash is exchanged. I'm buying by taking over the mortgage. That's the deal. Now, I've had deals where homeowners were in a very financial straits and they wanted to do that, but they needed money to move. Okay. So it may be incumbent upon you when you get these properties that you may have to make a deal with the homeowner. Okay, look, I'll give you $2,000 or $500, $1,000 to move with it. And I've done that, make people move with it, and they're happy. They got something, they go. Some people may have equity. I've had a divorce situation with husband and wife. They just were not talking. They were just so mad. They wanted to sell. They couldn't even think straight. They didn't want to sell the property and they had a $36,000 in equity. But of course, when they decided if they went to the table after they paid the realtor and the closing costs, most of the equity would be gone. So I made the deal. I said, hey, let me take over the property subject to the mortgage. I'll pay the existing mortgage. You got $36,000. I tell you what, when I do sell the property at the end of the term, all right, to whoever I sell it to, all right. Meanwhile, I'll make the mortgage payments. I'll give you a piece of that. What do you want? They only wanted like 10,000 a piece. All right. And that's 10, 10, 20. And I got the other 16. That was fine with me because I was making $389 a month off of the lease option I made. And I got about $7,000 from my tenant buyer. I was fine. So what I'm trying to tell you, you're going to get people who've got equity, but for various reasons, they may walk away and turn away. So you're going to have different kind of motivated sellers. All right. So the bottom line is, I'm bringing this up to you to let you know that this is in real estate manual, subject to. It's not illegal. It's here. Anybody tells you it's illegal because they don't know. They don't do it. They don't practice it. If a realtor tells you it, they must be brand new. They got to be brand new realtor. Most realtors in the game, they understand what subject to is. And they run across investors who do it. And they call us, you got a subject to property? Because they want it. They want them. They got buyers who want this kind of property. Okay. So the bottom line is, I'm just letting you know that subject to is a legal way of acquiring properties. It's a great way of getting multiple properties, without putting your credit on the line. All right. So that's the beginning of this course. This is how we start. The next part is going to be on Wednesday. So it's every Monday, Wednesday, and Friday at 7 p.m. And so today we were going into the theory and the basic premise of subject to, how it works, this, that, and the other. So the next classes that are coming, we're going to talk about the actual contracts. We're going to talk about the trusts. We're going to talk about marketing. We're going to talk about how to talk to the seller, how you do a lot of other legal things, the paperwork, because you got to have your paperwork. So a lot of people know the premise of subject to. Oh, I got it. We go out there, guess what? You have the right contract for subject to? You know, are there things in there that can protect you? You know what I'm saying? So I teach you all this. I actually have the real contracts that work in the real world. All right. So with that said, that is the end of our class. And I hope that you guys do have some questions. If you have any questions, I'll be happy to ask right now.
Yes, sir.
Yes, sir.
Two questions. First, two questions. First one is, when you switch and get the title into your possession in your name, I've heard of banks sometimes being able to make that loan due. Can they do that on you?
Oh, absolutely. Now, that's called the due on sale clause. And only because we don't have time. Normally, this class goes to another 20, 30 minutes, but I have an obligation. But we're going to cover that quick. And then what we'll do, we'll cover that extensively on Monday. That's called the due on sale clause. And you're right, Hilaria, the due on sale clause exists in every new mortgage. And what it means, and unfortunately, people there's misnomers about that due on sale clause. They think that it automatically triggers when someone signs the deed overdue. No, it does not. I've talked to lenders. The due on sale clause is in there, but it does not automatically trigger. The due on sale clause is an option for the lender to call the loan due if they find out that the homeowner has transferred it to someone else. And remember, I gave you the reasons why they want to do that, right? They want to make sure they get some interest, some down payment, check the buyer's credit, just to get some money and skin in the game. They don't want that private transaction to happen between. So that's why they put that in there. So there's ways to circumvent and stop the due on sale clause. Now, even though we're a little bit over time, I'm glad you asked that question, Larry. So I've had lenders probably about 7 times, I think, over those 150 something transactions, call me and threaten to call the loan due. They actually have. One lender called me, hey, Mr. Brown, I see you got this property, and we looked it up. And see, most times lenders are not going to go to the county recorder's records, but there's certain things that can trigger them to check. So this is what happened. And I said, yes. I said, Mr. Thomas or Mr. John, whoever he wasn't paying the mortgage payments. And I took over the property. And you can see I'm making all the mortgage payments. He was going to default. And they looked up and they, oh, yeah, he was default for 6 months. Yep. So I made up all those payments and I'm making the current payment. And they said, hold on a second. And they held on. Boom, boom. And they came back and said, well, Mr. Brown, thank you so much. Continue making mortgage payments. You're fine. They never called the loan due. You got to remember, if a lender calls the loan due and it's current, they have an investor who's making money off of those payments who they got to go to and say, well, we decided to foreclose on the property that you have an investment. He said, well, did they default? Were they making the payments? Yeah, they were making the payment. Well, why did you foresee? That's not going to happen. Banks are in the business of collecting that money and that interest for themselves and the investor. They're not going to foreclose. Trust me. And call the loan due if it doesn't make sense financially. If you're making the mortgage payments, even if they find out, they're not going to call the loan due. I have never had a lender actually go through with it. They threatened. Then I had the other lenders, their legal departments call me. Oh, I see you got the deed. We can exercise this. What they wanted to do, they wanted to get me to go ahead and get a loan and pay off the existing mortgage and make some money. Or they wanted me to put my credit on the line, this, that, and the other, yada, yada, yada. And I said, okay, well, I'll tell you what, what's your fax number? All right. And I faxed them over the trust. And when I faxed them over the trust, every single one of them answered me back, either by email, call, telephone, whatever it said. Thank you so much, Ms. Brown. We certainly do apologize. We see you do have a legal option here to do what you're doing. And thank you so much. Because it's legal to put your property in a trust. And according to the Garmin St. James Act, which we're going to get into, all right, that's another document that we didn't go over today. We will. I'm going to show you legally how the federal government allows you to put your property in a trust, which requires transfer of the deed, which doesn't trigger the due on sale. And if it does trigger the due on sale, you show the lender, you have, I'm telling you, every time I show them the trust, they back off. That's it. That's how you get around that, Brother Hilario. So that's the benefit also of the trust, is to keep yourself private and anonymous, and also to circumvent and stop the lender from calling the loan due. And remember, even if the lender knows you have it in a trust, even if they know that you transferred the deed over to you, if you're making those mortgage payments financially, they're not going to do it. The due on sale clause is not a trigger. It's an option for the lender. So if I'm missing payments now, if I took it over 6, 7, yeah, they can go ahead and do that. Or they say, hey, you know, pay this existing loan off. But if I'm making the mortgage payments, they're not going to do that. And they never have called the loan due ever. And most practitioners of subject to tell me, just like myself, that they never had the lender call the loan due because they were making the payments and they put it in the trust, to answer your question. But we're going to go into that deeper into the next session on Monday. Does that answer your question, Larry?
Perfectly. Second question is that once you have subject to and you have it in your trust or in your name, you can hire a realtor to sell the property for you, so you don't have to go looking for somebody?
Absolutely. Absolutely. You know why? Because you're the owner. So just like, let's say you're not a subject to practitioner, you didn't take the property, put it in the trust, you're not in the deed. But let's say I bought a property a traditional way, got the mortgage, got the deed. I go to a realtor, right? You know what the realtor is obligated to do? To find out if I'm the real owner of the property. That's all they want to know. Are you the real owner? Because when they sign that contract to sell the property, they have to make sure it's you, the owner they're representing. So if you're in subject to, you have the property in the trust, guess what? You're still you're the real owner too. I have realtors sell my, I don't like realtors to do it because I like to do it myself for sale by owner, make all the money. But I've had a realtor to do it. I've had a realtor bring a buyer, all right, and purchase the property from me. They just wanted to make sure I have legal authority to sell this property. So to answer that question, absolutely, you can do that. You can do it through a realtor. You can do it for sale by owner on your own, or through an investor, any way you want to do that. Yes, sir. Absolutely.
Thank you, sir.
You're quite welcome. So with that said, any questions? All right. So
I'll save it for later.
Yes, sir.
When you have
Save
more
for later.
time.
Okay, good. Monday is going to be fantastic because we're going to get more into it. Every time I teach this class, I get a little bit better because, you know, I'm a little rusty, but I'm getting better and better at answering your questions and give you this information that's going to help you to understand this is something good that you need to know. And let me tell you, when this real estate deluge comes, you're going to people going to be doing flippers, which means they got to get a loan, buy that property for a cheap price, put a loan on their credit, right? Now, remember, you can only, as a person, I don't care if you got an 800 credit score, the bank is only going to give you loans for a certain amount of properties, maybe 2, maybe 3 at max. Subject to, you can have 15, 20, 30 properties underneath your belt because the loans are not in your name, remember? You're just getting the deeds, all right? So you're not going to max out your credit, all right? And wholesalers, they don't never really own the property, okay? Which is a bonus. They're just flipping it to make some money. You can do that, but guess what? How much money are you going to make? Then you got to, after you flip it, you got to work on your next deal. Let me tell you, doing subject to, you're going to make money in the front, the middle, and the back end. And guess what? You're going to find a property, guarantee you, because it's happened to me plenty of times back in the day, that you like. And you're going to want to move in there. I've lived in places, because this is Phoenix, Arizona in the beginning, back in the day, where, you know, we weren't, you know what I'm talking about, wanted, some of us. I lived in Paradise Valley in neighborhoods where there were no blacks. I lived in Scottsdale. You know how I got into those neighborhoods? Because I had the property subject to. They couldn't do nothing about it. I was the deed owner and I moved in Queen Creek before it got big. I lived down there. You know, I experienced all that. You know, Ahwatukee, I lived down there too, in the nice areas and whatnot, because I had the property subject to. And it allows you to be able to find a property for yourself and your family that you may not have to qualify for with a mortgage, as far as credit and a down payment. You can move and just pay the existing mortgage. You're going to love that. What if you have friends or family who have evictions on their record, right? They might not be able to get into a rental. This is perfect for people who have prior evictions or eviction that's stopping them from renting. Their credit is down and shot. You get property subject to, guess what? You're not going through a credit check. You're dealing with a personal transaction between you and the seller, and you're moving in, you're getting the property, you're getting the deal. Boom. It's perfect. This is why I pitch this to our people, because this is an opportunity that others, and we know who they are, take advantage of every time this real estate crash comes. And we need to do this too. It's a tool to put underneath your belt. It's not the end all when it comes to real estate investing, but it's a good tool to know in addition to traditional wholesaling, traditional flipping. And I want to say this, when you get a property subject to, guess what? You can wholesale it. There's ways to get the contract from the seller even before you get the deed and put it in the trust and wholesale it to an investor, because the contract I gives you the same option as a wholesaler. You have equitable interest, so you don't have to own it if you don't want. You can wholesale it out. And guess what? You can flip it. Since you get it for, when you flip it, you're buying a property for, under the value, and you may have to put some money in it to bring it up to that extra value that puts that $200,000 or $150,000 equity in there. And you buy it, hook it up, get it subject to, and then you flip it and make the difference, sell it traditionally, just like you were saying with a realtor. Absolutely.
Quick question.
Yes, sir.
Last, I'm sorry, but
no, go ahead. I love the questions.
when-
I might continue. Go ahead.
the people who are allowing you to put their property under subject to, how likely is it that they're willing to allow you to stay on their mortgage for an extended period of time like that? Because, like, say for instance, if somebody's in a 30-year mortgage, which is the traditional one, right? And they're only 3, 4, 5 years in, they're not gonna let you be on the mortgage for 25 years, will they? Or whatever time period.
That's a very, very good question. And you know what? People ask me that. The number one question that the homeowners or the sellers who turn it is that when is the mortgage going to be satisfied to pay off? I'm honest with them. I tell them I do not know, but I say the way I do business, I said it is beneficial for me to get that mortgage out of your name as soon as possible, and for you. So I have ways and methods of doing that. I say if I can get the mortgage out of your name immediately by selling this property today, I would, but most likely I can't. However, you can't. However, I can, and I have the time and the means to go ahead and stretch this out. Now I tell them, and it's in the contract, it says I may get rid of it in a couple of months. It may be a 15 or 30-year mortgage. It may do that. I've never had one that does that. You see what I'm saying? But it may do that. And guess what? If you do take over that property and you're paying on it 15 years without fail, not missing a mortgage payment, what are you doing for the homeowner? You're making their credit very good, aren't you? Because you're making the payments.
What about their debt to income ratio and buying other properties?
Excuse me?
What about their debt to income ratio when they want to buy a different property to live in?
Beautiful. I like you because you ask the right questions. Brother Jay used to say we didn't ask the right questions. He couldn't put the answers out, but you asked the right questions. So that's number 2 that people ask. And the thing about that is you're absolutely right. People, maybe because of their situation now, they can't pay the mortgage. They got to move out. They got to downgrade, but maybe later on they want to buy a property, right? So there's ways to do that. Absolutely. So I tell people who want to do it, I ask them, what's your intention? You're going to buy a property? No, I'm not going to do it right now, or maybe a year or two. I said, I guess what? So there's something called an estoppel certificate. And that's a certificate that shows a new lender, okay, when I have a tenant in there, that the tenant is paying this mortgage, all right, by paying some money on top of the mortgage with their rent, all right. With that, I am making the mortgage payments, or my company is making the mortgage payment for the next 12 months. Okay, this is what I tell the seller, all right? So when you go to your lender, now it has to season for a year at least. And I've done this about maybe 15 times over the past 20 years because people had to do this. So what happens, I showed proof that I was making the mortgage payments for at least 12 months. And I told my seller, don't come back yet until at least 12 months have expired. All right. And when the 12-month period was up, sometime 15 months, they waited. All right. I was able to show proof to the new lender. All right. That even though the mortgage was in the name of the seller, okay, I was making the mortgage payments. So they looked at that and saw that the payments were coming from me. So that debt to income ratio, they dropped that drastically down. And the person every single time, Hilario, was able to get another home because they couldn't legally, they couldn't do it. Because legally it said I was making the mortgage payment and the mortgage payment was coming out of my pocketbook, not out of the former homeowner's pocketbook. In addition to that, the mortgage interest that you pay every year that you get from the IRS says whoever is making the mortgage payments can claim that interest too. So I also claim the interest. So I hope that answered your question, Larry. Did I answer your question? They're able to get a second mortgage after you season it and show that you're paying it, not them. every time it works.
Fully, clearly understood.
Yes, sir. Yes, sir. Isis, did you have a question?
Yeah, I was talking about the tax credit, and so you already answered that. So thank you.
Yes, yes. So another thing, people have called me after I take the mortgage over for like 6 months, 5 months, say, tax time is coming. I normally am able to claim the mortgage interest. So I tell people, look, since I just took it over this year and now taxes are coming, I legally am able to claim the mortgage interest. But sometimes I let people go ahead and do it because you can do it without any legal ramifications. However, I have the right, according to the IRS, and I can show you those guidelines, and I'll give those to you as part of this course that I'll tell you. The IRS states whoever is paying the mortgage claims the interest. Okay, whoever's paying the mortgage. Now, even though I'm paying the mortgage, I can claim the interest. I can pay the mortgage in a lot of homeowners. I've told homeowners, I tell you what, as part of the deal, I'll let you claim the next two years because I get the property, with no money down, and they sign the deed. And I've done that to give them a little bit more incentive to turn the property over to me. They like that. Okay, so that is a benefit. The other benefit, of course, you can claim the mortgage interest. So let's say you got 10 properties. You claim, what? Are you kidding? Let me tell you, there's so many benefits it's subject to, it's ridiculous. But it's something that certain groups don't want out there a lot. I've had investors early back in the day when I did this used to ask me, why are you teaching this? When they didn't want it to be taught. They did not want it to be taught, especially to specific groups of people. If you know what I'm saying, they didn't want it to be taught. I'm telling you, this is knowledge, skill that you need to have. Any questions? Come on with
What
your
about
questions. I'll give you a couple
contract
more.
remorse?
Pardon?
Like people who get into the deal, contract remorse. They get into the deal, they got a couple months pass by, they out of that panic mode, right? And then they're like, well, you know what, man, I just gotta find a way to get my house back. I got my job back, I got money. I don't like this deal anymore. You're gonna make more money than me, so I'm trying to see, you know how that can be. So
excellent. I love your questions. Those are real good questions. And let me tell you, it's the same thing that would happen if I traditionally bought your property and I had a mortgage and I paid off your mortgage and you change your mind, you want your property back. No way you can do it. I've got the deed. I paid for it, whatever. That's why I teach you this. Even though a lot of these people will give you the property without any exchange of money, all right? They'll just simply sign the deed over and exchange it legally. The contract says you paid exist. Give them something. Because when they take you to court, which people have, and the judge saw, okay, well, you gave this property to Mr. Brown under the premise that he would take over this mortgage, stop your foreclosure. Because people have tried to take the property back when equity started rising. They wanted to take the property back. They have done that to me and tried to. Every time the judge said, no, you can't do this. This guy had the property for 6 months. He'd been making the mortgage payments. All right. It says here you agree to that. You have some kind of buyers, and no, you cannot do that. The only way a person can get that property back if I sign it over to them under court order, and the judge is not going to order that if I've done anything improper. Okay. So they can have all the buyer's remorse they want, just like in a regular transaction. You can have buyer's remorse after you sold your property. Maybe it's family property, living there 25 years. Person got a mortgage, paid off the mortgage, whatever got there. I changed my mind. No, you cannot, especially after some time has passed. Now, with that said, what I like to do is when I talk to the sellers, I hammered them. You sure you want to do this? And then when we get close to the contract, you understand exactly what we're doing. And then, of course, the contract still has the 3-day right of rescission. And I tell people, take it to an attorney, take it to your real estate buddy, take it to a friend, and have them go over this. Make sure this is what you want to do. Bring them on the phone, bring them to the table with me, and let's see to make sure this is what you want to do. That's why I say you want to get the most motivated of sellers. Now, right now, there's not a lot of motivated sellers, and there's some out there because I've got a property or two already. But when the motivated sellers come, they're just going to sign on that dotted line and say, people shook my hand and said, thank you. God must have sent you. God bless you, because they just wanted to get out of this thing. Okay. So with that said, buyer's remorse can happen in any situation, in the traditional way and this way. And after some months, they're just not going to get it back. If they do, and there was one time I did do that, and that was because the person was talking to another investor, and the other investor offered them an extraordinary amount of cash. The person said, what? Because they gave me the property free, gave me the deed. And they changed their mind. I said, well, no, have me talk to the guy. And the investor came to me and he had to pay me cash for the deed. All right. So I never actually went back to the seller, but the seller got some money from another investor who gave me cash for the deed. Boom. But to answer your question, legally, buyer's remorse is not going to work, especially after months and time has passed. And if you do your things right, and I tell you, I've made the mistakes, Hilario, of not dotting the I's and crossing the T's, but now I know what to do. So when that certain things happen contractually, you have a solid case. And this is what I teach you. Okay, absolutely. Hope that answers your question.
Yes, sir.
Yes, sir.
Do you have to have a certain image to try to approach these people? Like you got it like that in order for them to be convinced that you can help them in this situation? You know what I mean? Do you have to play like that part, pull up in a fancy car, wear nice clothes? And because if you come looking like them, then I don't know if that's attractive, because, you know, opposites attract in these situations. So is that something that you know, you practice, or something that you encourage others to practice?
Again, that's a very good question, and I do advocate that. So when I was doing subject to early, me and I think it was Brother Larry and my ex-wife at the time, you know how we go suited and booted and stuff like that, whatever. That's how we would go all the time, suitcase, briefcase, woo woo. The other practitioners who were just like us in the same Phoenix area, they were in dungarees and, you know, maybe a dress shirt like this, little pen and whatever, and just casual. We would get the deals. And there was a particularly Italian financer who would buy these properties from us. Once we got it, they'd go to us rather than to go to these guys. And they ask us, how do you get people to sign the deed over to you? And you know why, Hilario? It's because we came looking professional. We had business cards. And I was the first proponent of website. Most people didn't do websites. That's why I say get a website, because nowadays people are going to have this. Everyone has a phone. Everyone has a laptop. And they're going to do some due diligence. Your seller, they're going to look you up and to see what's going on and see what you represent. And of course, to answer your question correctly, I highly advocate that you do represent yourself in a professional manner. Make sure you at least have an LLC. They can look it up at the Secretary of State, the Arizona Corporate Commission, or whatever city or state that you're in. Have a website with a phone number, a physical address, not your personal address, but a physical address, a fax number, all that kind of stuff. Emails that don't say Gmail on it, but say info@yourwhateverbusinessname.com, all that kind of stuff. You're absolutely right, because it puts on a good impression that they're dealing with someone who knows what they're doing. And first impressions are the lasting impression. You know what I'm saying? And remember, when the debacle comes, you're going to have a lot of investors who are going to be talking to the same seller that you're talking to. And he was more professional and sounds like they know what they're talking about, is going to be able to get the deal. And these white guys, excuse me for saying that, but they used to ask me, how the hell did you get people to sign the deed over to you? Because we used to sit down in the Starbucks and they used to brag, blah, 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 because we used to meet at Starbucks and a bunch of investors in the area. And there was only two black ones, me and Larry at the time. And they say, well, how do you get these deals? And then they talk about, oh yeah, well, you know, I made the deal and yada, yada, yada. And I gave them 5,000 to move and I gave them 2,000. Eric, what did you do? I said, you guys gave them money? They said, didn't you do that? I said, no, we just, you know, we represented professionally, correctly. And we did not come to the seller, I want to buy your house. I'm going to give you cash. I'm going to do a transaction. We came under the premise, I'm here to solve your problem. I'm here to help you. I'm going to stop this foreclosure. I know what you're going through. I have systems that can help you mitigate this and make this happen. So people saw us as problem solvers. So they were readily able to give us and willing to give us the deed and the property and walk away. So yes, to answer your question fully, professionalism, I absolutely advocate it. Absolutely. Yes, sir.
Thank you, sir.
You're quite welcome. All right. Well, I believe that's probably the end of this session here. And I thank you, Hilario, for the questions, because questions produce the answers and the information. If you hadn't asked these questions, I probably wouldn't be able to say all this, and maybe I would have thought about it in the next session and maybe not. But thank you so much. I hope you join us the next time. All right. That's going to be Monday at 7 p.m. And if you join us, and again, these are recorded, so I will send everyone who's on this call. And remember, there's people who pay for this course, people who are on who were supposed to be here, but because of obligations for home and work, they couldn't be here. So what I do, I record it and I send everyone, including you guys. You're going to get a recap of this in the audio and video form to your email, so you can click it and play it again and listen to it again. So if you miss a day, okay, you're going to be able to get it the next day. However, I prefer you not miss a day, because live interaction produces questions that I can give you the answers, and I'm full of a lot of information, and I want to give this to you. So with that said, I can keep going on and on. I'm very animate and I love this subject. It's really, really good, beside my number one subject, which is God. But hey, this is it. So with that said, I'm going to say, that said, thank you guys for joining. If you have any questions, text me, email me, join the group that I put in your email. And Hilario, please send me a text of your email so I can send you some more information. And thank you again for so much for joining me. Dale, Debbie, Eric, and everyone who's on the call. And we'll talk to you Monday. And God bless and be safe.
God bless. Good night.
Thank you. Have a good weekend.
All right. You too.
Secondary